So what does all this mean going forward? I think there's, as I mentioned before, a battle between two different scenarios or paths of monetary policy. The first one I'm going to refer to tonight, we're going to call it the Great Escape. And the reason is because it reminds me of the epic World War II movie where 76 Allied airmen escaped a German prison camp through a tunnel using just what they had in the camp. They had no Facebook, they had no Twitter. And I think the parallel to what we're seeing with central banks is quite appropriate, because I think in the US, finally, after 7 years, the US economy is strong enough that the US is finally able to normalize monetary policy and start to increase interest rates. Now, I know what you're thinking. You're thinking, monetary policy, is he kidding me? It's too late in the day to think about that, and I apologize. And I would point out, I don't know how many people have seen the movie The Big Short. They dealt with a lot of technical subjects, and what they did, it was quite brilliant. They had video segments of famous people describing technical issues in the mortgage market. In fact, there was one segment that had Margot Robbie in a bubble bath explaining what credit defaults were. So we thought tonight we would have John Nicola have a video segment, John Nicola in a bubble bath describing monetary policy. Unfortunately, that was vetoed by both our marketing department and our compliance department. So you're stuck with me. I'm going to do a bit of a primer on monetary policy. So what is monetary policy? I'm calling it the three-step process. The first step is basically the central banks lower interest rates. How much do they lower rates? Well, they do it as far as they possibly can, which is 0%. Why do they do it? Because it encourages borrowing. Cheap rates mean people will borrow more. They'll use that money and spend it. That increases economic activity. The other thing it does is it depreciates your currency, because if your interest rates are really low, no one's going to want to put their money into your currency. So it leads your currency to go lower. If that doesn't work, you go on to step 2, which is called quantitative easing. In this scenario, what happens is the central bank creates money. They effectively print money electronically, and they use it to buy back their government bonds. What happens with this is it increases the country's money supply, and that creates inflation. And the reason is if you have more money chasing the same amount of goods, it bids up prices of goods. It also tends to increase asset prices. Because remember, if the central bank is buying my bond, I've got to now do something with that money. I'm going out and buying corporate bonds or equities, and it bids up the prices of those. So that's a good thing and what the central banks want. What if that doesn't work? You go on to step 3, and that is negative interest rates. Now, I mentioned you couldn't go below 0, but apparently Europe and Japan proved us wrong and have actually moved monetary policy into negative interest rates. So what does this do? Well, it discourages savings. Who wants to save money if it's costing you money? That doesn't make a lot of sense. It also forces banks to lend. Why is that? It's because charter banks hold deposits with the central bank, and they get interest rates on those deposits. If interest rates are negative, they don't want to do that. They want to take that money out of the central bank and lend it to people, and hopefully that will lead to more economic activity. Finally, it does the same thing as the first two, which is depreciate the currency and increase asset prices. And I highlight those two because I want you to keep those in mind when we go and show some examples, because this is a key of what the central banks are trying to do with monetary policy. So how has this worked in the US? It's actually worked pretty good. And if you look at in the US employment market, the yellow line is the unemployment rate. On average, over the last 50 years, the unemployment rate has typically been just below 6%. As of February, it was just below 5%, so quite strong. Same for new job growth. On average, over the last 50 years, the US creates about 135,000 jobs a month. In 2015, they averaged 228,000 a month. And the story gets even better, because according to the annual report of the White House's Council of Economic Advisors, they think the US only needs to create just under 80,000 new jobs a month in order to absorb all the new workers coming into the workforce. And if they create 141,000 new jobs, it's going to drive the unemployment rate down to 4.5%. To give you an idea of what this means, for the first 3 months of this year, the US averaged well over 200,000 new jobs a month. That means the unemployment rate is going to go a lot lower. And what it also means is we can finally see the one thing we've been missing from the labor market, which is wage growth. That's been absent from this recovery. We think you're going to finally see that. That means consumers will have more money to spend. The US economy is 70% consumer spending. It's a big driver of economic growth in the US. So this is a very good thing. The other thing we are very bullish on is the housing market. You can see the yellow line here. This is builder optimism. Anything above 50 means builders are very optimistic. You can see that line has been above that red line for a number of years. It means builders are very happy. And why are they happy? Because they're building a lot more new homes. That white line is housing starts, and you can see that it's trending up higher. It hasn't reached the same level as before the Great Recession in the housing bust, and we think that it has a lot more upside because of that. Now, one of the reasons we're optimistic is if you look at home sales, existing home sales last year, they were at their highest level since 2006, and even better, there are not a lot of homes available for sale in the US. There's only a 4.4 month supply. A balanced market in the US and Canada is about 6 months. That means the US needs to build new homes. Residential construction and housing added about 25 basis points to GDP growth last year. We think it can do a lot more. So we're very bullish on the US economy. It's something you don't hear about. It's a good news story. What does that mean for US monetary policy? Well, you can see this white line is showing the Fed funds rate. This is the overnight rate in the US. It has been stuck at 0% for 7 years. On December 16th of last year, the Federal Reserve finally increased rates because of what was happening in the economy by 25 basis points. But the story is even better than that, because again, the US was working under the assumption that you couldn't lower rates more than down below 0%. But the effective rate, as calculated by the Atlanta Fed, with all the quantitative easing programs they were doing, meant that the effective rate was actually lower than 0. In fact, they calculate minus 3%. So what this means is you haven't just tightened 25 basis points, you've actually tightened 325 basis points, and you've been doing it the last 1.5 years. This is the Great Escape, and it's a good news story for markets. Now, the key on the Great Escape is it can't be just the US. The US may be the first out of the tunnel, but the rest of the world has to follow, and that's what we'd expect to see happen.